All right. Well, I think we're on the hour. We want to keep this to under an hour. I know Alp could talk for days about his favorite subject, taxes, but thank you everyone for tuning in and joining us today. Welcome to our 2023 edition of our annual year-end tax planning essentials session. I try to do this most years, and luckily, the IRS and Congress are constantly making changes. So there's always new good stuff to talk about every year. If you don't know, my name is Jason Dahl. I am a certified financial planner and a partner at AFS Financial Group. And with me here today, of course, is my colleague, Alp Adebeck. Alp is the founder and managing partner of AFS. I know we have some folks tuning in from the AFS 401k sides. Just a quick reminder there, Alp and I at AFS Financial Group, we operate as a separate entity from AFS 401k Retirement Services, but we definitely collaborate oftentimes, especially when it comes to things like financial wellness programs and webinars such as this. Also, just a quick reminder, please ask questions at any time. I know we did get a few questions ahead of time, so we will make sure we address those. But at any point, please type in a question or even a comment if you'd like to add something to the presentation in the Q&A link on your screen. Alp and I will track those, make sure we address those over the course of the presentation. We will also follow up. We are recording the presentation, so we will follow up in the coming days with the link to the recording and some additional materials to the presentation. And if we got a question where we said, hey, you know what, we want to maybe get back to you on some component of that, which is not uncommon. I'll say probably our favorite question is, can I schedule a time to speak with you, Jason and Alp? And I want to encourage anyone to please do follow up with us after the webinar. If you have further questions or would like to schedule time to connect, to go over a few things, Zoom, phone, in person, we definitely love meeting with folks. We love what we do. And the favorite part of what we do is connecting with folks like yourself and helping you solve personal financial planning puzzles. So again, don't hesitate to reach out. All right, so let's get going here. Of course, we've got the obligatory disclaimer. This is being recorded on November 30th, 2023. So if you are listening to the recording, just keep that in mind that, hey, things will change. We're going to talk a little bit about both some of the 23 tax numbers and figures. We'll also talk some 2024 figures and numbers as those change from year to year. But we always, for today's purposes, we're just going to talk broadly, right? Generally, some background and tips and things, but of course, always consult directly with your advisor, tax, financial, or estate as appropriate. And here is kind of today's agenda. Alp, being the reformed CPA, he's going to lead most of today's presentation, but kind of start with covering some of the basics on the tax code and taxes, making sure you're sort of laying the framework for the different types of income and different types of taxes, deductions, credits, and then really want to spend some time thinking about some of the strategies, whether they be year end, so that need to happen, or things to think ahead to the coming year. So how you feeling, Alp? You ready to roll?
I'm ready to go.
Right.
Thank you for that introduction, Jason. And I'll say that one thing he didn't say is we make the assumption that if you're doing your taxes yourself, that you're using tax software. The one I personally use is TurboTax, because a lot of what we're going to go over today, the software will do everything as long as you input the information correctly. So when they ask you certain questions on the software, make sure you're paying attention and throwing in the information, and it will take care of a decent amount of, I'll call things like tax credits and certain deductions. All right, so we're all familiar with federal tax, especially living in the DC region. We're also familiar with state taxes, but most people don't realize there's 7 states that do not have a state income tax. That is on the next slide. Jason, if you are able to move that forward, there you go. And most people don't think about this, except when they're debating a new home for their retirement years. They like, oh, where can I go that's a warmer climate? Even though we have had one person went north once, which is very unusual, just not the trend. Most people go south. But they look at climate as well as the tax policies of the state they move into. And 2 of the most popular states these days are Texas and Florida when it comes into, I think Florida tops that list. And not only are individuals moving in for retirement, you're now starting to see businesses that have high income employees and team members moving their headquarters down to tax friendlier states. So the main ones we all know, as I said, on this list, I always like to point out, think of Washington State. That's where Microsoft is. And so Bill Gates in all those years when he sells off his Microsoft shares was never paying state income taxes. And I think Elon Musk of his various companies, he actually has moved some of their business operations down to Texas, away from California, just because it's a much more tax friendly.
Texas and Nevada have kind of been receiving some of those Californians for that,
without a doubt,
those purposes.
But the highest income group is definitely Southern Florida right now, without a doubt. So there's different types of income, ordinary income, and then there's capital gains and qualified dividends. So the main type is ordinary income, and ordinary income is taxed up to the highest tax bracket, which currently is 37%. So we have the examples of the main ones: wages, interest income, dividend income. Dividend income in theory has a little bit of an asterisk on it. I'll go over it on the next slide. Business income, Social Security income, retirement income, rental income, unemployment, all of that, they're examples of the main sources of ordinary income. And it's going to be taxed at whatever tax bracket you are in. In addition to that, there's qualified dividend income and capital gains income, distinguishing between short-term and long-term. Short-term capital gains, basically under a year. Assets sold, let's say at 11 months and 16 days, that will be taxed as a short-term capital gain. That is taxed as ordinary income. Long-term is taxed between 0 and 23.8%. And when you're looking at your year-end 1099 qualified dividend income, that's also taxed between 0 and 23.8%. So the highest rate is a lot lower than that 37% tax bracket we talked about on the previous slide. This is why Warren Buffett always comments that he pays a lower tax rate than his administrative assistant, because his income is mostly derived from qualified dividend income or capital gains. He takes a very modest salary at a question, Berkshire Hathaway.
Yeah. Sorry. A question we see fairly frequently is, why does my 1099 distinguish qualified dividends, ordinary dividends? And here's the reason why: I just said how it will be taxed.
So you've got to input that. Obviously, if you're going to an accountant, they input it properly. But if you're doing it yourself, you have to put it in under as a qualified dividend, and it's broken down perfectly on the 1099. So how do tax brackets work? So the next slide shows you how the brackets work. And so we have a progressive system in the US. And so you can see the various tax brackets ranging from 10% all the way up to 37%. And you see the various filing statuses. To make this a little easier, we did not include married filings separately, just so it would fit in easier on the slide. But in this example, to show you how it works, if somebody has 100,000 of taxable income, so that's after they take either their standard deduction or itemized deductions. So 100,000, you can see for single filers, if their income's taxable income's between 95,375 and 182, those dollars above 95,375 will be taxed at the 24% tax rate. All the other income up to that level is going to go through the brackets. So again, it's a progressive system. For a single person that has taxable income over 578, all their additional dollars are being taxed at 37 cents on the dollar.
I think most tax returns at the end, when you're done, will show you what was your highest marginal rate and then what was your average that you paid, right? So to Alf's point, that blend, it'll sort of tell you, depending on how much was taxed in each of the levels, what the average comes out at.
So on your taxes, you don't just pay taxes on your total income. They allow you to either take a standard deduction or an itemized deduction. So you're either going to take the standard or itemized depending on how much of deductions you have. So the standard deduction for 2023 for a single person, 13,850. Married filing separately, same thing. Married filing jointly, 27,700. The standard deduction increased substantially in 2018 with the Tax Cut and Jobs Act. And I was just looking this up this morning. Now almost 90% of US taxpayers take the standard deduction. That's a combination of this deduction getting so large, and also because of all the refinancing of the last, I'll call it up until 2022, but people had refinanced all their mortgages down to 2-3% mortgage rates. And because their mortgage deductions are so small and they cap the amount you can write off for state income taxes, there's a lot of people that don't itemize that think they're itemized. And you still go through the exercise every year to see whether you itemize or not, and the software will tell you what to do. But I will say this, there are times it can actually make sense to force itemizing, even if your standard deductions are better. And I'll go over that in a little bit. But if you look at the next slide, this is the different types of itemized deductions. These are the main ones: medical expenses, state and local taxes, mortgage interest, investment interest expenses, charitable contributions, and miscellaneous itemized deductions. We list that there, even though that's mostly been eliminated. And we'll start going through them one by one. So medical expenses, you can deduct unreimbursed medical expenses that exceed 7.5% of that. You see that term AGI, that's adjusted gross income. So if somebody's adjusted gross income, use easy math, is $100,000, that means their first 7,500 of unreimbursed medical expenses are not deductible. It's only the amount that exceeds it. So if they have, in that example, 9,000 of unreimbursed medical expenses, they would get a $1,500 deduction. And what counts as unreimbursed? So think of anything that you pay for out of pocket with after-tax dollars. If you're paying for it with your HSA, that would not count. But think of things like glasses, co-pays, medical equipment, unreimbursed counseling expenses.
Sorry, the insurance premiums themselves.
Yep. Paid with after-tax dollars. Sometimes
right.
through companies, they're paid through pre-tax plans. Dental expenses, prescriptions, etc. And the area that we see that people usually exceed the threshold if they have a lot of expensive dental work, and this usually kicks in later in life. You could have somebody that might have $15,000, $20,000 of dental work over a 3 or 4 month period. And in those examples, you do see people that actually itemize their medical expenses. One other big one is assisted living expenses, nursing home expenses. At times, there are a lot of planning opportunities there. So we have a few clients right now that are actually in assisted living facilities, and they could be paying anywhere from $6,000, $7,000, $10,000, $15,000 a month for those expenses. And generally they're categorized as medical expenses if they can't take care of themselves. And somebody we're working with right now, they're paying about $120,000 a year of unreimbursed assisted living expenses. So they're going to get a very large deduction on their taxes in 2023. And what we do to take advantage of that is, if they're reducing their income to a low tax bracket, and sometimes we have people in retirement years that they're actually taking their taxable income below zero, we actually try to create income to take advantage of the low bracket. And one easy way of doing that is taking money out of retirement accounts over and above the required minimum distribution, where I'm working with somebody, I think just this morning, we pulled over 30,000 from their IRA over and above the required minimum distribution in 2023, just because we're going to be in a super low tax bracket. So it's very beneficial to plan in those situations.
Good foreshadowing out for later in the presentation. We're going to talk a little bit more about some of those other opportunities that may also include doing a Roth conversion, which is essentially the same thing of accelerating some taxable distributions from an IRA, but potentially either just taking it and spending it, or converting it and depositing it into a Roth IRA. And I think the medical expenses too, I would add, I think a lot of times folks, if they're not itemizing, right, and like you said, 90% of taxpayers are now taking the standard deduction, but then they have that one unusually high medical expense year, then it's, okay, I've got 15,000 of dental, for example. Now go collect all those receipts that you normally, in previous years, you weren't keeping track of, right, for all the premiums that you paid, the out-of-pocket co-pays, all that sort of stuff, and because that's worth it.
Without a doubt. So state and local taxes, this basically changed a lot in 2018 with the Tax Cut and Jobs Act. Used to be unlimited. You could write off your state taxes, real estate taxes, personal property taxes. Right now it's capped at $10,000. $10,000. And so living in the DC area, for people that are working, they're usually well above this, especially, homes, the taxes could be, 10, 15, 20, $30,000, depending on the price of the home. So all of that is actually capped at 10,000 since the Tax Cut and Jobs Act. It's going to be capped through 2025. But there is a big however there. There is a workaround in many states for what is called pass-through entities. And some people jokingly will say this was a creation of the blue states that didn't like the fact that their high-income taxpayers couldn't write off their state income taxes after the Tax Cut and Jobs Act. Nonetheless, there is a workaround in the state of Maryland. So make sure you talk to your tax advisor if you are a business owner or partner in a pass-through entity. You probably can pay your business taxes through the business and circumvent this $10,000 cap. It was probably about a year or two ago. I was talking to somebody that was a very high income earner. I think it was around $4 million a year. And his accountant had not alerted him to this. And this was around September of the year. So he still had time for that particular year to play catch up. And so in that example, I think this person pays something like $300,000 of state income taxes. And because of this rule in the state of Maryland, he was able to write them off pre-tax. So again, circumventing this $10,000 threshold. So there are workarounds. Talk to your tax advisor. Again, very dependent on the state that you live in. Mortgage interest. You can deduct mortgage interest on up to $750,000 of mortgage debt for homes purchased after December 16th, 2017. This also includes home equity loan interest that was used for home improvement. So if you have a $600,000 mortgage first trust and you bought your house after 2016, 2017, if you also have a $300,000 home equity line, you can actually write all of the interest off on your first trust, and basically $150,000 of the debt on the home equity line would qualify for this. For homes purchased on or before December 16th, that threshold is higher. $1 million of mortgage debt is eligible to have the interest expense written off. Special rule, if you were under contract on a house before December 16th, 2017, and you closed before April 1st, 2018, you actually get grandfathered into that $1 million threshold. So if you borrow money to make investments, so if you do it on stock accounts, that's called margin interest. Some people buy raw land. That's just investment interest. So if you're basically borrowing money to make money, there's usually a way to tax deduct it. If it's a rental property, it'll just go on Schedule E for the rental properties. But if you just buy raw land for an investment, you can write off the interest as investment interest expense. It's for, I'll say, if you're buying it for investment purposes as opposed to building a personal residence in the next year or so. But still tax deductible. That was not eliminated with the Tax Cut and Jobs Act. Charitable contributions. Everyone is familiar that you can write off charitable contributions. We'll go over the main ones. You have to pay it by cash, check, or credit card. If you've got a lot of cash going out, you want to make sure you have a contemporaneous record of it. Credit card ones are easy to verify. What I always like talking about is the non-cash charitable contributions. The main ones are clothing and furniture. I always think people overvalue, back in my tax days, the clothing they give away, and generally undervalue things like furniture. So, there's sometimes they're giving away some really nice furniture, and it's, if you were to sell it, it would get a lot more than people think, but clothing generally worth a lot less. In addition to that, you can actually donate appreciated securities. They have to be held for 1 year or more. So it's a long-term capital gain security. And so, for example, if somebody has Apple stock they bought 10 years ago, and they have a very low cost basis, you can actually donate that to a charity and deduct the full fair market value of what you donated. So if you donated $15,000 of Apple stock, you can take a charitable contribution of $15,000 as long as it goes to a qualified charitable organization.
And I'll say pretty much every charity has the ability to accept. There might be some small charities that have never set up a simple kind of brokerage account, but most charities have that ability. You just contact them. A lot of them post it on their website, or you can just ask them, hey, what's your brokerage account info so I can send you shares. And then
So
the
you
charity
actually sent, go ahead, Jason.
sorry. So they send it, you as the donor send it directly to the charity, and then the charity can sell the stock. And because it's a tax exempt organization, they don't pay any tax on the gain, right? As opposed to you selling it, paying the tax, and then donating the cash. It's a much more tax efficient way of donating.
So miscellaneous itemized deductions have been eliminated since the Tax Cut and Jobs Act, with the exception of gambling losses used to offset taxable gambling income. So very few people take advantage of that unless they got lucky with the lottery, or if they went to a casino and somehow got a 1099 when they cashed out, then they can offset their gambling losses against it. So when do you itemize? We have a couple slides that give some really good examples of that.
Before you go there, we had a good question before we kind of wrap that up. Can you deduct medical expenses that you pay for an adult independent child?
Make a note of that. I think we looked at this before. I think there was certain ways you could possibly do it, but I want to double check it. So if we make sure we have that person's name and email, we can get back on that.
Yeah, I think we may be talking to them soon, in fact.
All right. Simple enough.
Yeah.
Makes it easier.
Thanks for the questions.
So when do you itemize? So this is a great example of somebody married filing jointly, and you see their various deductions. They've got the SALT deductions, state and local taxes of 10,000. That's the cap. Mortgage interest of 10,000. Just threw that in there for convenience. That's not really capped. Charitable contributions of 2,500. So their total deductions were 22,500. As a married couple, their standard deduction was 27,700. So generally, they're going to take the standard deduction. As I said, there are times you could possibly force taking the itemized deductions if it gives you a better net benefit. A lot of times the state tax returns, you cannot itemize on the state unless you itemize on the Fed. And so sometimes when people are really close to that threshold, they will actually double check how they will come out on their state tax return. And if itemizing on the state saves them a lot of money, then it's one of those things that I'll call it good software, or a good accountant should be able to pick up and steer you in the right direction.
And just a quick comment, the asterisk here, the standard deduction is even higher if you are age 65 or over.
And the software will take care of all that for you. This is a single filer. They've got $7,000 SALT deduction, 8,000 mortgage interest, charitable contributions of 1,500, total 16,500. The itemized deduction is larger than standard deduction. So this is a time when they would clearly itemize, and so they pay less tax by itemizing. They just have to document their deductions, and it all gets filled in on Schedule A on their tax return.
I just want to take a moment here because I think this chart does a nice job of outlining a point that we'll talk a little bit more later around kind of year-end charitable giving strategies. But if you know, whether it be because you had medical expenses, that were deductible that year, or new mortgage because you refinanced, you're now in a higher interest rate mortgage, right? And you're now itemizing. Here's where you can sort of think about, well, do I want to maybe front load some charitable giving, right? Because you might be already above the standard deduction. So go ahead and do some additional charitable giving this year, and then maybe you skip next year. It's a strategy that some folks will do to sort of alternate, to kind of lump a lot of charitable giving to itemize one year, take the standard deduction the next year. Let's go for it. I've got another question here, but I'll read that while you continue here out.
So this is probably one of the ones that is really good information. So the common tax credits.
I will interrupt you there,
Ralph,
before we go for it. Sorry, because this is a great kind of question to wrap up the deductions. Can you take the mortgage interest as a deduction on a second home combined with your primary residence?
Yeah, it's capped at that same limit. So if both of them were bought before 2017, whatever the date was on that, it's capped at 1 million. The software will automatically calculate. So if your total mortgages were like 1.2, there's actually a formula that the software will have you go through. They'll put in the beginning balance on January 1st of 2023 and the ending balance of the loan balance on December 31st. And it'll actually automatically calculate how much is actually eligible as a tax deduction for 2023.
But yeah, short answer
First
is
and second
yes.
home is yes, you can write it off.
All right, sorry.
So the common tax credits, the ones we're going to focus on are home-related tax credits and the electric vehicle tax credit. And excuse me, I'm going to read here, but this is actually some really interesting changes. The residential clean energy credit. So if you install an alternative energy system in your home that relies on a renewable energy source, such as solar, wind, geothermal, or fuel cell technology, this credit is for you. Solar panels, solar electric equipment, solar power water heaters, and wind turbines, we've never really had that one come up, are eligible for the credit. And beginning in 2023, the credit also applies to battery storage technology, with a caveat: it has to have a capacity of at least 3 kilowatt hours. And so the size of the credit, and just so you understand, a credit is a 1-for-1 reduction in your tax liability. The size of the credit is 30% of the cost of the equipment and installation for renewable energy systems. So if you're putting a battery backup in your house, Uncle Sam is now subsidizing 30%. This full credit goes through 2032. After that, it drops to 26% in 2033 and 22% in 2034, and it expires in 2035. One thing to keep in mind, there are some states that might give you some additional benefits. And I'll give you an example. I have a house that the prior owner put in a geothermal system in it, so it qualifies for this. And after I bought it, the heat pump needed to be replaced. So the cost of that plus the installation was tax deductible. Back then, it was actually only a 26% credit, but unbeknownst to me, when I bought it, I didn't realize that. I was like, oh, I get a 26% subsidy on this. But the state of Maryland also chipped in $500 by just sending them the receipt of the repair, which makes 0 sense, but obviously was happy to take the free money. Energy efficient home improvement credits, the tax credit for installing energy efficient windows, doors, etc., has been completely revamped. I'll skip what it was in 2022. The credit is now bigger and better for 2023 through 2032, the same systems that they were talking, the same limits that they were talking about earlier. First, the credit percentage increases to 30% of the cost of certain types of insulation, boilers, air conditioning systems, windows, they have to qualify, doors, etc., added to your residence. There used to be a $500 lifetime limit, and now it's a $1,200 annual limit. So it's a big change from the past. A few nuances, you just want to double check to qualify. But if you're doing a couple of different projects and it qualifies for that, I'm going to say you probably want to split them into different years. So if you were going to do some by the year end 2023, do some in 2024 to make sure you get the $1,200 on both years. The EV credit, obviously a popular topic now, so that got revamped substantially. Usually, the car salespeople will have all the information there and tell you whether you qualify, but you just want to double check on certain things. I'm going to read this. It says for 2023 through 2032, the maximum tax break remains $7,500 for buying a new EV, but the factors for figuring the credit are now to be eligible for the full $7,500 credit. EVs put in use after April 17th, 2023 must meet a critical minerals requirement and a battery component rule. If only one factor is met, then the credit is capped at $3,750. Eligibility for the full $7,500 credit for EVs put in use before April 18th is based on the vehicle's battery capacity. Also, the final assembly of the EV must take place in North America. The last rule applies to all EVs first placed in service after April 16th, 2022. And there was, they basically now allow Tesla back in. Tesla had maxed out their ability to claim this credit in the past. There was a limit, I think the first 200,000 cars or so, but now all are eligible again. There's a couple of new rules that claim the tax credit. It says if you buy a new EV, first, the manufacturer's suggested retail price can't exceed $55,000 for sedans and $80,000 for vans, SUVs, and pickup trucks. So that's a big issue. Second, there is an income limit. You can't claim the credit for purchasing a new EV if your modified adjusted gross income, which is generally your total income with a few add backs into it. If your modified adjusted gross income exceeds $300,000 for joint filers, $225,000 for head of household filers, or $150,000 for single filers. They also brought in a used EV credit, but that has a it's max credit of $4,000 or 30% of the sales price. The credit isn't available if your modified adjusted gross income is more than $150,000 for joint filers, $112,000 for head of household, or $75,000 for single.
So if you bought an EV, new or used, or you did some home renovations, talk to your accountant about what you may qualify for.
And we have people that are building homes. I think that's something that's also important there. If you're building a house, you want to try to figure out what you can do to qualify for some of these credits. And it could be substantial depending on what type of systems you put into it.
Yep.
And so the other credits, a lot of them everybody knows about. The tax software will take care of that. One I'll just highlight a little bit. If you adopt a child, make sure you double check what you're eligible for tax credit wise. And so, did you skip the, there you go. Did you skip the 2023 child?
Oh yeah, sorry.
Just like these, like the software will take care of this. This is one interesting thing is like up to $2,000 per qualifying dependent child age 17. There's phase outs on incomes, but it is interesting. My wife was the youngest of 8, and I was actually thinking through this for them. I remember when this rule first came out, basically, I think the first $100-something thousand of income for families of 8 on the Fed return was tax-free with these credits. So really interesting. But one thing I wanted to highlight, a portion of these credits are now refundable. And what that means is if you wipe out your full tax liability, so if your total tax liability was $16,000 and you've wiped it all out through the credits, basically you can get a refund. They'll give you more than you actually paid into the system. Again, some rules apply to it. The software will figure it out, but it is a fascinating change. Family tax credit, let the software handle it on the next slide. Student loan interest, this generally most people get phased out of it, but it is tax deductible. Now that student loan interest is accruing again, it's something to double check on your tax return, or if you've got kids that have student loan debt and they can qualify for this deduction, it's something they should monitor. Jason, over to you.
Sure. Yeah. And I just want to comment. I know we had a question about 529 contributions, and we are going to address that. We have a slide on that. So we'll get that in just a few moments. So health savings accounts, a good plug here. I'll say that we have a number of other recordings on different subjects. In fact, HSAs, we have an entire webinar just dedicated to HSAs. We're big fans of them for folks who qualify, right? So you need to be enrolled in a high deductible health insurance plan to be eligible to then contribute to a health savings account. But probably the main reason why we really like the health savings accounts is, again, assuming you are eligible and enrolled in a high deductible health insurance plan, they have kind of a triple tax-free benefit. And what we mean by that is contributions are a deduction. So they reduce your taxable income in the year that you contribute to the HSA. Any interest earned or investment growth within the HSA grows tax deferred. And then the money comes out tax-free so long as it's used for qualified medical expenses. And the definition of qualified medical expenses is very broad and vast, I'll say. The IRS kind of lists out, many items that qualify for that. And it includes even things like long-term care insurance premiums sometime in the future. But one comment I'd like to make is that if you are taking advantage of a health savings account, contributing to it, taking the deduction, and you have enough additional cash flow elsewhere or savings elsewhere to pay out-of-pocket expenses, we encourage folks to not pay those out of the HSA. Let the HSA money stay in the HSA, grow tax deferred, and cover any of the out-of-pocket expenses from your cash flow or other after-tax savings. we oftentimes will run into folks that say, hey, yeah, we're great. We get the deduction every year, but then we spend it out of the HSA every year. And we often encourage folks to sort of think about it differently, to let the HSA grow and compound, and because it can serve a lot of flexibility perhaps later in life, or if you have a sabbatical, for example, and you're not working. I guess sabbatical is not a great example, but if you're just not working for a year and don't have health insurance, and an HSA, if you have built up a balance, there can be a great bridge to use tax-free money to cover the costs of health insurance while you're not covered by an employer. Or fast forward for folks that are retiring before reaching Medicare eligibility. We see this quite a bit. So somebody might be retiring at age 63, let's say, no longer have employer-sponsored health benefits. They're not yet eligible for Medicare, so they've got a couple years in that example to bridge. And building up a balance in an HSA can be a great tool, again, to use tax-efficient dollars to pay sort of the more expensive health insurance premiums during those gap years, if you will. And then I touched on this briefly, but just want to reiterate that within an HSA, almost all of them have the ability, once you've met sort of a minimum threshold that you've built up at the balance, to then open up a brokerage account that you can then invest the additional funds. And think of it as almost like a 401k plan, where there's a lineup of available choices, and you can pick and invest the money to grow long term.
And I'd say if you are doing that, just make sure you look at it in context of your overall plan, where you don't want to have that. If you're trying to be more conservative with that account, be more conservative with it. But if you want it to grow tax-free and you stick it in the market for 15, 20 years, then I'm going to say it's a great tool, great resource to have.
And here we put on the screen the contribution limits. You can contribute up to these limits. Actually, we were just on a call yesterday with somebody who's planning to retire mid-year next year, go on Medicare. And so we get this question quite a bit. Once you're enrolled in Medicare, by definition, you are no longer in a high deductible health insurance plan. So you're no longer eligible to contribute to an HSA. So that's an important one to note. But HSA contributions are also pro rata. So in this example, I think it was in May of next year, they're going to be enrolling in Medicare. So for the first 5 months of the year, they could contribute to the HSA. So 5/12 of this limit, you can contribute to the HSA. But, probably the most common deduction, if you will, that a lot of folks take is through pre-tax contributions to retirement plans, whether it be to a work or an employer-sponsored retirement plan, a 401k or 403b, for example, or a traditional IRA, right? So you can see here on this third row, the contribution limits into a 401k. These are going to go up next year, I think $500 higher next year. So it's, if you're under age 50, you can put in $22,500. Then if you're 50 or over, you can do a catch-up contribution to bring it up to $30,000. Noting that there is no income limits for contributing to your 401k. You may also be eligible to contribute to an IRA. However, the ability to deduct the IRA may be limited based on income. So we wrote no income limits because you can always make non-deductible contributions to an IRA if your income exceeds the limit. But there are income thresholds for deductibility for IRA contributions. Now, the question we get often is, I'm max funding my 401k. Are you sure I'm still able to contribute to an IRA? And yeah, you can do both. And then another question is, well, what if you're married and only one member is working and has earned income? That earned income can actually allow for both spouses to contribute to IRAs.
That's one that we see missed a lot. Like, there's possibly an opportunity to take a spousal IRA deduction.
Yep. And so then similar, there are Roth 401ks, Roth IRAs. Of course, the difference being money that you contribute to a Roth goes in after tax, right? So you don't get the deduction up front, but someday in the future, when you draw the money out, it comes out tax-free, right? So it's kind of the flip of a traditional 401k or IRA, where you get the deduction up front, grows tax deferred, but when you take it out in the future, it will be included as taxable income.
And Jason, I know one thing we didn't mention is some people work for employers that have, in addition to a 401k or 403b, they might have a 457 plan. Mm-hmm. And many of them allow people to put contributions into both max out both, where the state of Maryland allowed you for state employees to basically have the 403B as well as a 457 contribution. And for people that were able to afford it, I'll say after they've paid off all their college bills for kids, et cetera, you see a lot of them max out, getting caught up for retirement and just putting as much money as possible on a pre-tax basis.
And I know one of the questions we got ahead of time, let me just confirm it, was related to backdoor Roth contributions. Is the backdoor Roth still an option? And yes, backdoor Roth contributions are still an option. Folks are able to do them. They're a little bit complicated, but they're pretty common. And I'll just touch on this for a moment. So if the idea being, well, if I exceed the income limits, and so I'm no longer eligible to contribute directly to a Roth IRA, you could potentially make a non-deductible contribution into an IRA and then convert that to the Roth. Right? Because you did not get a deduction for the contribution to the IRA, the conversion to the Roth would not be taxable to you. And on the next slide, we're going to talk more about Roth conversions, but just laying the groundwork there, right? If you convert an IRA balance, just say you'd convert $10,000 of your IRA to a Roth because you say, hey, I want more money in the Roth. That's money that's going to be totally tax-free in the future. Well, the IRS says, well, you need to pay tax on that conversion at the time that you convert it from the IRA to the Roth. So for the backdoor Roth contribution, keep in mind that if you already have money in an IRA and you say, oh, but so I want to start doing backdoor Roth contributions, there's a pro rata rule. So if you make the non-deductible contribution to the IRA and then you try to convert it to the Roth, the IRS says, well, what percentage or what pro rata percentage of the contribution relative to your IRA balance is what you're converting, and that's the amount that would be tax-free. So it's a little bit complicated, but in essence, if you already have an IRA balance, it's not as simple to just make the backdoor Roth.
And I'll say not as tax beneficial. It's very simple, very straightforward. If you just have qualified work plans and no IRA.
Yeah.
And it's by spouse. So if you've got an IRA and the spouse doesn't, that person can potentially do a backdoor.
Yep.
So we've already talked a little bit about what the Roth conversion is. It's simple. It's just changing it from a taxable account to a Roth tax-free growth for life. As Jason mentioned, it is a taxable event. So for example, if you were to convert 40,000 of a fully taxable IRA to a Roth IRA, it will be 40,000 added to your taxable income in the year that you actually make the conversion. We're making the assumption that you don't have what's called a tax basis, what Jason was just talking about. But for example, if it's fully taxable, then when you make the conversion, it's basically going to be completely taxable on your return for that particular year. And so there's a lot of reasons why you might want to consider a Roth conversion. I would tell you that you're taking a look at your current bracket and your future tax bracket. So Jason, you want to go to the next slide? And so if you happen to be in a low tax bracket now, let's say you took off a year of work, or you retired before a pension kicks in, or you retired before you're collecting Social Security, you might be in a really low tax bracket for a number of years. And so in those scenarios, we have people do Roth conversions to take advantage of the low tax brackets. Jason also gave the example earlier, if somebody had negative taxable income due to a lot of medical expenses, in those scenarios, they can actually take some of the money out of their retirement accounts and convert it to a Roth to bring it above zero taxable income and go as high up as they want. Frequently in our office, we're taking it up through the 12% tax bracket. It's also taxable on your state return if you live in a state with a state income tax. But a lot of work goes into this. It's something that we think can make a lot of sense in the long haul. And one thing to keep in mind, that whenever when you convert the money into the Roth, the money inside the Roth, there are no required minimum distributions. So that money then can grow tax-free for life. It's just a great generational.
Yeah, I was going to add, if you're kind of thinking, hey, you're set for retirement and you're starting to kind of think multi-generational planning, Roths are a phenomenal tool for building up assets to pass to the next generation, because as Alt mentioned, over your lifetime, you won't be required to make minimum distributions from your Roth. And as a recipient inheriting a Roth, while there are distributions that are required to be taken, they're not going to be taxable. So,
and I will say, I know we got asked a question on the IRMA schedules.
Yes. Yeah.
One thing to keep in mind, so if you have a lot of expenses, we have people that have $200,000 of medical expenses and wipe out a lot of income. However, if you accelerate a lot of income through a Roth conversion, you could potentially be increasing the amount that person pays for their Medicare premiums.
Yeah,
so it's something to think about. There's some hidden taxes at times, so you have to be mindful of that.
And I believe the specific question we got on that was, are those thresholds, there's bands for that IRMA tax, income related medical, I forget forget it for a second, but basically there's thresholds for if your income is above certain levels that you pay higher Medicare premiums. And yes, those are adjusted with inflation.
And I think the tables are out. I think it might have been her question.
Yeah, I think
if you
those
Google
just
it, I think
out.
they came out just a little while ago, and it'll show you what the 2024 thresholds are. Yeah. Other things, other reasons to consider a Roth conversion or just doing a Roth. I'll say somebody's age. For younger people, if you have the opportunity and the resources, if you can have that money in a Roth for 30 or 40 years and you're in a low bracket now, it might make sense to do Roth conversions at a younger age. So if you've got money in a work 401k plan and you're in the situation where, hey, I don't need this money right now, can I just do a conversion? And it can make sense. So it's something case by case we would look at, but for people that have a really long-term outlook on it, we think the Roths are just a fabulous tool.
Yeah. And kind of a fun slide a little bit, or maybe not so fun, depending on what state you live in, looking at the different, where states rank, but just kind of continuing on sort of that Roth conversion theme, right? If you know you are going to be moving from a high state income tax state to a state with perhaps no state income, the common example around here, going from Maryland or DC down to Florida, you can hopefully get the idea. Oh, it may make more sense to wait and do Roth conversions when you become the Florida resident, right? So you save on the state taxes. Yep.
Yeah, something to keep in mind. Like if you do a Roth conversion while you're a Florida resident, someday, if you've got a lot of extra money in the account, if your kids inherit your accounts and they live in states with state income taxes, they're going to be pulling the money out and paying state income taxes. If they're a Maryland resident, a California resident, they will pay the state income tax of those states. And so at times, if you don't need it, and if you're thinking generational, it can make sense to do that conversion, as Jason said, in that state without a state income tax.
It's another way of kind of increasing gifting to the next generation. All right, where you can essentially pay the future taxes for them, right? By you paying the tax, converting it to the Roth, you're saving them the taxes that they would pay. So it's a way of continuing to gift to the next generation. So college 529 plans. We had a question earlier. Just want to make sure I address that one directly. Are contributions pre-tax or after tax onto a 529 plan? Great question. One of the benefits of contributing to a 529 plan is it may be deductible on your state tax return. There is no deduction on your federal return for contributing to a college 529 plan. And this applies to whether it's the 529 savings plans or the 529 prepaid plans. Same deal when it comes to the tax deduction. So to get the deduction, you need to contribute to your home state's plan, right? So if you're a Maryland resident, you need to contribute to the Maryland 529 plan. If you're a DC resident, the DC 529 plan. A Virginia resident, the Virginia 529 plan. Right? Of course, it's irrelevant if you live in a state with no state income tax, right? You can contribute to any plan. And in fact, you can contribute to any state's plan, but you only get the deduction for contributing to your home state plan. We've recently been discussing this, that you can actually, if you have money in, say, the Virginia 529 plan, and you are now a Maryland resident, I know that's taboo for some people, the idea of crossing over, but you can actually move money from the Virginia plan into the Maryland plan and qualify for the state deduction. Another tip is if you are helping to pay college bills, whether it's for a child or maybe a grandchild or another loved one, and you haven't been funding your home state 529 plan to pay those bills, we would encourage you, rather than paying them directly to the college, first open and fund your home state 529 plan, get the state tax deduction, and then
if it allows it, right? If it has a deduction.
Yeah, again, for these 3 states as an example, yep, and then pay the college bills from it. Another kind of simple tip to save a little bit on state income taxes.
And what's our special rule for Virginia, Jason?
Oh boy, yeah, yeah. Virginia clearly had some over the age 70 influential lobbyists at the state level. It's an unlimited state tax deduction for donors over the age of 70. Whereas for folks under the age of 70 and at any age for any of the other states, you're capped on relatively modest levels for how much you can contribute and get the deduction, but it is unlimited.
And they have carryover rules in most of those states.
Yeah, you don't lose it. If you exceed that limit in one year, you can carry it forward to the next year. But yes, Virginia has a very generous rule for, typically if it's grandma and grandpa who want to contribute for grandchildren's 529s, they can get it.
For example,
unlimited.
If they put $100,000 in and they have more than $100,000 of Virginia taxable income, they're deducting that full amount in 1 year on their Virginia return.
So for the sake of time here, we're just under 10 minutes left. We'll keep rolling here. We talked a little bit about this earlier. Just a quick recap. Great way of kind of tax efficient giving to charity is donating appreciated securities, right? So the example we gave earlier, right? Rather than you selling the Apple stock, for example, that you have, paying the cap gains and then donating cash, just donate the equivalent amount. Say you wanted to make a $5,000 donation to the charity, just send them $5,000 worth of Apple stock. They sell it, they're a tax exempt organization, no taxes owed. You get the same value from the deduction perspective of whether you wrote a check or send them $5,000 of stock. It's worth a $5,000 deduction to you. And the charities happy to sell it and use it for their cause. Similarly, you can contribute appreciated securities into donor advised funds. This has become a much more common tool that folks have been using in recent years. To think of, we always like to draw the analogy again back to sort of the Bill and Melinda Gates Foundation, right? So this kind of serves in the same way, but just in a much smaller scale for most people, where like Bill and Melinda donated all of their very low or zero cost basis Microsoft shares into their charitable, their community foundation, or family foundation, and got the deduction, and then were able to sell the shares with no capital gains taxes, and then from there they can send out gifts to the charities. Ultimately, same thing works here. You could open up a donor advised fund, donate appreciated securities to the donor advised fund. Say, we have a lot of folks who will do this. Will say, hey, I have in my retirement budget that I want to continue to donate $10, $15, $20,000 a year to charity. I'm getting close to retirement, so I know my taxable income is going to go way down after I retire. So the bang for my buck from a deduction perspective is high now. So they kind of front load their future charitable giving. So they might put a large $100,000 of appreciated stock into the donor advised fund, be able to write that off in their high income years, and then when they're in retirement, be able to send it out at the normal pace that they normally do. So if it's maybe $20,000 a year, they can just send it out of the donor advised fund at that pace. There is no time limit or restriction on when you have to send the money out of the donor advised fund. So really great tool to kind of maximize and be more strategic in your charitable giving.
And just to clarify, you get the deduction when you put the donation into the donor advised fund. You could leave the money in there for 5-6 years. When you start giving it out, you do not get a tax deduction.
Then you get a second tax deduction, right?
It's basically the donation is made when it's put in, and you have to sell the securities inside the donor advised fund to avoid taxation on it.
Yep. So it's a very simple graphic of what we just described, right? Put in 30,000, and then you can send them out to the charities that you want to support as you please. Another great tool for tax efficient charitable giving. If you qualify age 70 and a half eligibility, and you want to give to charity, But maybe you're well below the standard deduction threshold, right? So you're not gonna give enough to itemize. Well, this is a common tool that folks will say, oh, I have $50,000 of required minimum distributions that I have to take, and if I take it, it's going to be taxable income to me. So the IRS has a carve out that says you could send all or a portion of that required minimum distribution directly to the charity, and it not be included in your taxable income. So, right. So it's a little bit tricky. Kind of the first year you do it, make sure you tell the accountant, because your 1099 is going to show that you still received the same $50,000, withdrawal or distribution from your IRA. So on your return, you'll say, hey, I took 50,000 out, but only X amount was taxable, right? If you gave all 50 to charity, then none of it was taxable. If you gave 20 of it to charity, then 30 of it is taxable in that example.
And capped on this, Jason?
Yeah, so you can do up to 100,000, and I believe that actually for the first time in a long time is set to go up next year. Don't quote me. I think I read it was going up to 105,000 next year, and then set to increase, index to increase in the future. Here are the ages for required minimum distributions. There's been a couple bump ups over the last few years. It used to be 70 and a half was the year that you had to start taking distributions from your retirement accounts. But now it's age 73 for folks going forward. If you're not already subject to required minimum distributions, unless you were born in the year 1960 or later, then you can look forward to not being forced to take distributions until you turn 75.
Remember, you can take the distributions at any point after age 59 and a half.
With no penalty. No.
You're not forced to until you get to these ages.
Till these ages.
Yep. And that only applies to taxable accounts as opposed to Roth accounts. Or traditional IRAs, I'll say.
And Alp, I think we wanted to make a comment here too, that it seems a little funny, but now under the new rules since 2018, even if you're subject to RMDs, and you have to take distributions out, if you're still working and have earned income, you can still contribute to an IRA or a SEP IRA if you're self-employed, right? So while the IRS says you have to take minimum distributions out, if you're still working and earning, you can still contribute and take a deduction depending on income levels to an IRA.
I think the gifting rules are fairly straightforward. 17,000 a year per recipient without filing a gift tax return. Married couples, 34,000 a year per recipient. Above that, you have to file a gift tax return. The recipient of the gift doesn't pay tax. You, the person that is given the gift, the government will track it. But if you gave somebody $100,000 and it's just, you're an individual, no spouse, give somebody $100,000, you're 83,000 over the limit. The gift tax return will take that into account. You don't pay any tax unless you've exceeded a massive limit. It's probably 13 plus million right now.
Yeah.
Under the current tax law, and it gets tracked on the gift tax returns. But when you exceed these limits, it's really not that big of a deal for most people. This limit increases to 18 and 36 for 2024. One thing to remember, in addition to these rules here, you can pay educational expenses and medical expenses directly in addition to the annual gifting limitation rules. So for example, if you're gifting somebody 17,000 and they're actually in school, you can actually pay their tuition bills directly, and that does not count as a gift. Mm-hmm. Same thing with paying medical expenses directly.
Yep. Orthodontists, so forth, right? You could pay those bills directly.
So it's tax loss harvesting time in taxable accounts. This doesn't apply to anything in retirement accounts. You can actually recognize losses to offset capital gains, as well as go what we call $3,000 negative. So if somebody had 5,000 of net capital losses for 2023, they can use 3,000 of it to offset their other income in 2023. 2,000 will be carried over into the future. There's a rule called the wash sale rule. You can't sell something, for example, on December 4th and buy it back before 31 days. Otherwise, they'll call that a wash sale and they'll disallow that particular loss. And you can also write off losses on cryptocurrency. So something to keep in mind, if you have that crypto account that basically has lost a lot of money and you don't pay attention to anymore, you can actually sell the positions and take a tax loss.
I know we're coming right up on the hour, which is great because we're right to the last couple slides. You want to wrap us up?
Yeah, sure. So when you talk about what has to be done before year end, so contributing to your 401k, 403b, mortgage prepayment. So if you have a mortgage payment due January 1st, if you want to write the interest off on that payment, you have to make sure that the mortgage company receives it before December 31st. And if they do, you can actually write that interest off in 2023. If you're doing a Roth conversion, that's a calendar year thing. So if you do it on December 25th or 20, I'll pick a different day where it's not a holiday, pick December 27th or December 28th. That is all you need to do. It has to be done before December 31st. Same thing with charitable giving, the 529 contributions. Gifting rules, I'll just touch upon a little bit. You want to make sure that if you're giving out those $15,000, $16,000, $17,000 gifts, that those checks are cashed before the end of the year, just to make sure that the government wants to make sure you don't basically write a check in January if you miss the year. They want to see those checks cashed. By April 2024, whatever the due date is, you have to fund your IRA and SEP IRA contributions, the HSA contributions. If you're trying to defer income, that's one strategy. So if you have a super high income year in 2023 and you don't want to take any more income in, if there's an ability to defer bonus compensation to where you might have a lower tax bracket in 2024, it's something to do. And if you're in a high income year, we've kind of talked about some of these things, you might want to try to accelerate deductions into 2023. So it's one of those things, just comparing the years and what makes the most sense.
Thank you, Al. But with this question, I'm going to tee this one up for you. Are payments for an adult child's wedding considered gifts?
They are not. Well, so
gifts.
Actually, it's an interesting question. So Natalie, who's on this call, my daughter, we just had her wedding, and as far as I know, I don't know anybody that's ever actually filled out a gift tax return for the wedding, but it's actually a very good question.
Great question.
I mean, in theory, you're throwing the party, so I wouldn't consider that a gift. I guess if I logically think through it, you're hosting the party, so it's not really a gift to that person. I'll stand by that. That's how I'm handling that.
Exactly. Yeah. First time we got that question. Thank you.
That is a good question.
So, well, thanks everybody for sticking with us today. Hope you got some good information. As we've started with, feel free to reach out if you have additional questions. Happy to schedule time to connect. Visit our website. We have a lot of recordings of various topics, whether they be on HSAs or retirement income planning, 529s, insurance, you name it. Got a lot of great handouts, infographics, so forth. So just check us out there. Here's our team. As I said, feel free to reach out, and I know we're 2 minutes over, so thanks for joining us today, and wishing everyone a wonderful last month of the year we're coming up on. Wow.
It's crazy.
All right. Take care. Be safe, everyone.
Bye.
Goodbye.